You funded your own loan with your signature on a promissory note. How banks leverage promissory notes to create money. The financial mechanisms employed by local banks mirror those of the Federal Reserve and the national government. While the Federal Reserve prints new currency, local banks generate checkbook money every time they issue a loan. When an individual applies for a loan, the bank requires them to sign a promissory note. This note is then endorsed, typically with a stamp reading "Pay to the order of," and deposited into a transaction account under the borrower's name, an account created without their knowledge or consent. The bank then writes a check from this unauthorized transaction account to either the borrower or the designated recipient of the loan funds. Subsequently, the bank sells the promissory note to the Federal Reserve or securities markets, securing proceeds that ultimately fund the loan. Thus, unbeknownst to borrowers, their own signed promissory notes serve as the very assets financing their loans. The illusion of a loan, a misrepresented transaction. Upon signing a promissory note, borrowers provide an asset that can be exchanged for cash. In essence, the loan process is not a loan at all but an asset exchange. The moment a borrower signs the promissory note, the document itself becomes money to the bank. Under the Uniform Commercial Code, UCC, a promissory note qualifies as a negotiable instrument and, therefore, as legal tender. The bank can monetize the note immediately, treating it as an asset that increases its financial holdings. Meanwhile, the borrower perceives the note as having only future value rather than present value. The bank's deception lies in its misrepresentation of this transaction as a loan rather than an exchange. The bank risks nothing, its assets do not decrease, and it does not lend out pre-existing money. Instead, the borrower provides the value in the form of the promissory note, which the bank then monetizes for profit. Despite this, the borrower is charged interest on an alleged loan that, in reality, they funded themselves. Understanding the banking fraud, a simple illustration. To illustrate this system, consider the following scenario. A borrower requests a $10,000 loan. The lender agrees but demands an asset worth $10,000 as collateral. The borrower offers a diamond ring worth $10,000. The lender takes the ring, sells it for $10,000, and then gives the borrower a $10,000 check. The lender then demands monthly payments at 10% interest. If this were a private transaction, it would be deemed fraud, loan sharking, and racketeering. However, this is precisely how banks operate daily, effectively exchanging borrower-provided assets for checks while deceptively labeling the transaction a loan. Federal Reserve publications admit the truth. Even the Federal Reserve acknowledges that banks do not lend money in the traditional sense. Consider these statements from Federal Reserve publications. Transaction deposits are the modern counterpart of bank notes. It was a small step from printing notes to making book entries crediting deposits of borrowers, which the borrowers in turn could spend by writing checks, thereby printing their own money. Modern money mechanics, P3, Federal Reserve Bank of Chicago, of course, they do not really pay out loans from the money they receive as deposits. If they did this, no additional money would be created. What they do when they make loans is to accept promissory notes in exchange for credits to the borrower's transaction accounts. Modern money mechanics, P6, Federal Reserve Bank of Chicago, in exchange for the note or security, the lending institution credits the depositor's account or gives a check that can be deposited at yet another depository institution. Two faces of debt, P19, Federal Reserve Bank of Chicago. Bookkeeping entries reveal the deception. Banks' own accounting records provide further evidence of the fraud. When a depositor submits a $1,000 check, the bank records this as both an asset and a corresponding liability, maintaining a balanced ledger. The depositor retains the right to withdraw their funds at any time. However, when a borrower signs a promissory note, the bank deposits it into a transaction account and records it as an asset, just as it would with cash or checks. Nevertheless, instead of acknowledging an equal liability to the borrower, the bank instead treats the note as if it were lending pre-existing funds. In truth, the bank is merely exchanging the borrower's note for a check, which then pays for the borrowed asset. Why are borrowers paying for something already paid? Given that the borrower's promissory note was monetized and deposited as an asset, the loan has already been funded. In reality, borrowers should owe nothing, as their note provided the necessary financial backing. However, banks still demand monthly payments and interest, despite not having issued real money or incurred actual risk. Who really owes whom? If banks acknowledged the true nature of these transactions, they would owe borrowers, not the other way around. Banks retain liability for the promissory notes they sell, as the transaction was an exchange rather than a loan. Despite this, they continue to collect principal and interest payments, profiting immensely from a process that is fundamentally deceptive. Understanding this scheme is the first step toward financial awareness. It is time to question the legitimacy of these banking practices and demand accountability from institutions that profit from misrepresenting transactions as loans when, in fact, they are asset exchanges.